I want to get to some of the questions. We've had a number of them come in while we've been on the phone. As a matter of fact, we've had many questions come in, as you might imagine. The first one is, why is deflation bad? Somebody asked, if it's going to make prices decline, if it's going to make assets more affordable, then why is that a bad thing for us to suffer through that?
Well, I tell you, it's a great question. That's what we say all the time. Economists think bubbles are bad, and they're the best magnifier of innovation in the entire cycle. They think deflation's bad. It's exactly what brings efficiency back after a great innovation period like the Roaring 20s or what we've seen in the 90s and 2000s. It is good for the economy, but it is painful. It is like detoxing off of a drug or something like that. I see these things where the junkies are shaking and all this stuff and detoxing or whatever. It is like that. It's painful. I mean, banks go under. People lose massive amounts of assets, and businesses go under and consolidate. But the businesses that survive have a lock on their leadership for decades to come and are hugely rewarded. And the investors that are smart enough to see it coming and hold cash and liquid stuff and high-quality stuff, their money buys more and more. But the real winners are the next generation of consumers, the echo boom, our kids and grandkids. And the next boom does get the efficiency. And people are complaining now, hey, the rich have gotten rich, the top 1% control 45% of the wealth. That is not going to last. That was the same statistic in 1929, and by the mid-'70s, only the top 1% only controlled 20-some% of the wealth. So we are going to see a much broader-based boom that's going to benefit many more people from these new technologies. So deflation is good and it's necessary. The government, unfortunately, is in a position of saying, we're not supposed to hurt from our coal. We don't want to hurt. Give me a pill. And so they're going to try to prevent it. And all they're going to do is rack up a lot of debt. And they're going to run out of money by the time we really hit the bad part of the storm in 2010 and beyond. And I'll tell you, my prediction is by 2012 or 13, we're going to have to be turning to China and the Middle East to bail us out because they're holding the cash reserves in the world. And they have much stronger demographics. So that's going to be humiliating. But yes, it is going to reduce prices, the cost of business, cost of living, and it is going to be good in the long term. And the greatest mass boom in history was not the Roaring 20s. It was the 40s, 50s, and 60s after the Great Depression.
So looking at it right now, and this is some of what we talked about ahead of the call and told people we wanted to get through, if somebody handed you a bucket of money today and said, okay, it's straight cash right this minute, what would you be looking to do with that today? No history to it, no strings attached. What is it you think you'd be looking at now to consider for, say, the next 6 months as we get into that period where we expect the bailout to be working and growing the economy again and pushing those commodities higher?
Well, on the conservative side, I would be out of bonds and I would buy TIPS. I'd buy inflation-protected Treasury bonds on the conservative side, and on the most aggressive side, I'd be buying oil and natural gas. I think those are the commodities best set to do. I think commodities will outperform stocks, but within commodities, I like oil, natural gas, silver, gold. I think they'll do better than the ag and the industrial metals on the bounce. And then in stocks, I want the stuff that got hit the hardest. I want emerging markets, I want Asia, and I want the financials in small caps. So that's aggressive. Now, obviously you can go in between and buy just more large cap stocks, and then all the way if you're just very conservative, hey, just buy inflation protected bonds and get a low yield, and they should appreciate if we get inflation and as normal bonds depreciate. So that's where I'd focus. You just have to really consider whether your risk tolerance and whether you're a more conservative investor or a more aggressive.
Right. And just as a disclaimer, we do have a money management portion of HS Dent where we hold positions in some of these things. They're certainly our best ideas, and so they're the ones that we work in internally as well. You say that you see the bounce here coming, and you laid out scenario 1 and scenario 2, and it looked like the bounce is either somewhere between 1,000 points up to the mid 9,000s, or maybe 2,500 points up to 11,000 or so. Are those the two kind of basic scenarios?
Yes, and I think at this point that we're leaning. I think scenario 1 is more likely. I think we're going to see a more extended bounce. It's going to last longer. It's going to be choppy. And in fact, right now, I would not be buying stocks right now. I would wait for a pullback here. We're getting overbought near term on our technical indicators. We're getting close to this kind of head and shoulders neckline we kind of suggested, which would be about 93.50, 9400. I think if we get there, you ought to wait. Stocks are likely to pull back 1,000 points or so, back to 8,000, 7,800. Come back and retest that low without making a new low. I think we have put in a low. When we get back near that low, I think that'll be the time to be buying these things we said, or commodities and stocks, and be looking for a bounce that is likely to last, I think, at least into maybe April, and then maybe as late as July or August or something like that before we start getting inflation problems and other problems. So, I think we're going to see the more substantial bounce. But, if you're a conservative investor and you've had enough of this crash and we get back to, 9,800 or 10,000, it may be worth it. I think you're going to see closer to like this 11,800, 12,000 target we have.
And we're going to lay out more of this in the newsletter in January too, correct?
Yes, yes.
Okay, good. So we'll have some of this timeline in there so we can talk through these things more specifically. Somebody's asking about hyperinflation. We get this question a lot. If the Fed's putting so much into this, we've committed well over $3 trillion. That commitment is not a payment. There's no plan right now to spend $3 trillion. What we do is as a government, we are insuring money markets. We're insuring some commercial paper funding facilities and some other things. The spending is roughly around $1 trillion, which is still a phenomenal amount of money. What do you see of the risk of hyperinflation from us putting so much money into the marketplace?
Well, see, I don't see hyperinflation because we do have the deflation cycle has started to set in well. We really got a war between inflation and deflation here. And again, what we are very clear about is deflation is going to win in the end. There's no two ways about that. Now, if the government just goes absolutely berserk, maybe. But this is not like the German hyperinflation, or I think it's Zimbabwe or somewhere that's happening currently, where they just print money unbelievably and literally printing money, not just IOUs and treasury bonds. They're literally printing dollars. That ends up in hyperinflation. All it would take to kill this rebound, if we just saw that the 30-year treasury, if we really went back to 5-6% inflation, which we were at just months ago with a rebound, and the treasury bonds started saying, oh my gosh, we're no longer in deflation, we're in recovery mode, well, they'd be 2 points above that. They'd be at 7%, say, and then mortgage rates would be 2 points or more above that. They're at 9. If we had 9% plus mortgage rates, the housing market would get cremated. So you can see why the government's in a trap here. If they succeed, we're at least going to get some type of inflation pressure, and that says, hey, you can't keep inflating when inflation is now the problem and deflation is no longer the problem. And then as soon as they stop inflating, we know from our commodity and demographic cycles that we're set for some strong deflationary downtrends. And in fact, in our books, we show that even without the baby boom downturn in spending, just the retirement of the baby boom's impact on the workforce would cause deflationary trends in the next decade. So deflation is where it's going. And as soon as the government stops inflating, and of course inflation has its own consequences, high oil prices, high interest rates, the economy is going to slow. And then this time we're going to go into deflation, and the government's going to be too late to prevent it, and they're going to be totally out of ammunition. So I don't see hyperinflation, but boy, if we just saw inflation rates go back to 5-6% and interest rates go up that much, it would kill a rebound.